Hello, this is Jeff Bish, president of MarketGauge.com, filling in for Keith for this week's Market Outlook. Please be sure to take 2 seconds to vote on your opinion of which way the market's going to go over the next several weeks in the sentiment survey that you see on the screen below. And if you haven't done so already, please register to make sure you get emailed when this Market Outlook comes out each week. It's free, and what we hope to do is give you a little bit of insight each and every week in terms of what's going on in the market. And for me, my objective here in this video is if I can just point out 1 or 2 things that are worth keeping your eye on to help you become a more informed trader in terms of what's moving the market, then this video is a success. Last week I looked at the TLTs and interest rates and how those could be a positive or negative factor for the markets going forward, and also told you to focus on the 10-day moving average of the markets and let that be a barometer of when the markets are ready to have any meaningful correction. So this week I'm taking a little bit different tact, something that you might not be looking at, something that may or may not impact the market for weeks at a time, but it would be nice to see it coming so you're not blindsided when it does impact what's going on. And what I'm referring to is the relationship between the euro dollar and the U.S. equities. And I'm going to use the SPY's S&P 500 as the proxy for that. And what I've done here is I've got the weekly chart of the SPY's up top, the euro dollar down below, and I've put in vertical lines, which you can see here, these dotted vertical lines. And I just did a very simple exercise which you can do, and I'd encourage you to do. I went back. I'm showing you about 2.5 years here. And again, this is weekly, so it's going to be slower in terms of the relationship. But I took the vertical lines and I put them at major turning points in the euro. Okay, so these are all the points. And so I wasn't trying to pick bottoms as a predictive measure, just pointing out where there were significant swing areas in the euro. And I want to highlight this for you. So here's a significant area. How does that play out with the SPYs? Now, in this case, the direction of the euro is down, and the SPYs during that same period actually are flat, but granted did have an up move. But typically what we're going to see here is euro bottoms, stocks bottom, euro tops. In this case, euro tops and sells off a little, stocks ignore it that time. Euro bottoms here, starts moving up, stocks continue their move higher. So in this case, in through here, they're really, stocks are just strong. I would say regardless of the euro, although you do get a slight pullback when the euro gets weak. More importantly here, euro puts in a top. You don't know it's a major top at the time, but stocks also put in a significant top. They bounce at about the same point. Euro slides, and from the slide we make a little bit of headway in the stocks. Euro rallies, stocks rally nicely. Euro tops, stocks top. Euro, it didn't really bottom here, tries to bottom. The real bottom comes in a little bit later, right about here. Either way, both situations kind of put upward pressure on the stocks until the euro pauses. US, or I should say stocks pause, and now euro bottoms, stocks move higher. So where does that leave us? Okay, now I've put a vertical line in here because of the pattern in the euro this week. All right, so what I didn't want to do is just start the video and say, hey, look what happened in the euro. You've got a reversal pattern here. You close below the low of the prior week, and that is a negative sign. It's a particularly negative sign if euro continues lower in the upcoming week, and it's particularly negative because it's right at the 200-day moving average. It also happens to be right around the 50% level from this move down. Okay, so if you took a 50% move, it's in and around this area. So I'm not saying this to say that's it. Euro has topped, therefore the stocks must top. Again, I'm pointing this out so that you can be ahead of the curve. One of the things you're going to want to look at in the weeks going forward is whether or not the euro dollar gets weak. First step is, do we break lower next week? And you always want to let the stocks and the price action of the stocks confirm. Stocks have just been resilient to any effort to sell off. So the question really is, when they start to sell off, is it going to be a real sell-off, or is it going to be just another 1 or 2 day wonder for the bears, and then the bulls take back over? So what I propose here, the importance of this is that if the euro continues to get weak, if it's weak next week, weak the following week, and stocks show weakness, then I'd be more concerned with the weakness in the stocks. If the euro continues higher, I would expect more just upward pressure on the stocks themselves. All right, it's pretty simple. Like I said, it's not something that you have to react to every single day. Look at it from a bigger picture point of view. But the reason that I'm highlighting it now is, again, because you're at the 200. You have a negative weekly pattern here that, if it confirms next week, really deserves your attention. All right. So that's the outside, kind of from left field piece of information to keep an eye on going forward. I just want to take a quick look at some of the regular indicators that we look at. There isn't a lot here to suggest that this market is topping. So I'm not going to spend a lot of time on it. I'm just going to point out, if we look at the McClellan, we're not over bought in any way. The only thing that is interesting and runs through all these indicators, they're all based on advanced declines, or up-down volume, is that the rally is strong and the breadth is not getting overdone. The indicators that most of the people I hear talking about in terms of overbought all have to do with just price, distance from the 50-day moving average, distance from the 200-day. It is extended. There's no doubt the market's extended, but the market can continue to get extended. So we want to keep an eye on whether or not the market gets too thin, or the breadth gets too thin. But for right now, the breadth certainly isn't suggesting that we're the opposite, which is completely overbought, not by the McClellan anyway. If we just look at the 10-day sum of advanced declines, we like to see this spike higher and then pull back down, and that would be the indication that the market is too frothy. But right now, the pullback or the spike, we'd need another spike in this to really suggest that it's overbought. It's just not overbought. And finally, on a shorter term basis, we've got the shorter term, the 12-day advanced declines, and 5-day volume. We like to see these both blow out at the same time to indicate overbought. Clearly, that's not happening. One other indicator I'll take a just glance at here is the ratio between defensive and non-defensive industry groups. And so when this indicator turns up, as it has, it's an indication that the market is more aggressively buying defensive. However, This little turn up is not enough to worry about, just like the euro that I just talked about. Not a reason to go screaming for the exits. One thing you will want to keep an eye on, however, is if the market, again, gets weak, then you want to know whether or not the weakness is showing up even more so with a stronger push towards defensive names in the indexes. So, one last typical look or typical indicator, keeping an eye on the VIX. There's just nothing here other than the fact that it is depressed. Nobody seems to be worried. Complacency is probably the biggest concern that we have, but it's basically flatlined. So as you can see, the typical breadth and various indicators are not suggesting anything dramatic in terms of overbought. It's not to say the market couldn't sell off, but we're not in a situation where markets are so overbought that we need to be worried about it. So let's take a look quickly at just the basic indexes. What I had said last week, and I'm going to repeat it this week, is one of the things, if you're looking for a major correction, I would look for, here's the 10-day moving average, this green line that I'm going to make white. It has held the market very well. For a significant correction to occur, we're going to have to trade below this, spend some time below it, try to rally back up, and then fail. So I'm not trying to catch the first leg down ever. So I'm not going to worry about the first leg down. It's going to happen. We'll trade it. But for a bigger picture, we've got some work to do before we have to worry about it. However, again, another little warning sign: the broadening wedge up here with the SPYs is not really what you want to see for an extension or a continued move. It would typically suggest we should get a little bit more chop, a little more consolidation before the next leg up can actually be a significant one. That said, we could still grind our way higher. So SPYs still at the top of this channel or this resistance line, but not going to try and pick a top, just watch the price action. Qs, really nice looking breakout here in terms of breaking out of a lot of consolidation. I would like to point out, however, that this breakout was pretty significant. This one was an attempt at a pretty significant breakout, and both times it fell right back in. So it's been unable to break out and follow through. Let's see if it can do it this time. A lot of this could depend on Apple, as Apple's a heavy weighting in here. IWM also has its own channel that is not in the right place. Oh, I'm sorry, this is a parallel. If we take this parallel, in much the same way we were looking at the SPYs, this should be some form of resistance. It's held it up. Perhaps I could say it's slowed it down from its the beginning of the year rally, but it just seems to want to continue higher. You can see it pushed higher again after having some what I would describe as messy consolidation. So grinding higher, wouldn't be surprised. Pullback, wouldn't be surprised. Major top, not ready to say that the conditions are there for that, especially as I said last week, and now it's happening. If the Qs break out and continue higher, that could be what this market needs to continue to fuel it. Dow, as we've heard all over the news, also broke to new multi-year highs this week. We're looking at a daily chart, but keep in mind it also is still at the top of that channel. I pointed this out last week, and so for all intents and purposes, yes, we've moved higher since last week, but not a whole lot. It's been rather choppy, so I would expect a grind higher or more chop, and I would not at all be surprised at more days like we saw Thursday, a big drop down seemingly out of nowhere. I'll point out the big drop down was related to Europe fears. That again is going to be reflected in that euro. All right, one last chart here I want to point out, because we look at the Qs, but you also want to keep in mind that the Qs are the big tech, big cap tech. You've also got the CompX on NASDAQ, which is a much broader index. And if we look at the longer term picture of that, completely different than the Qs, right? It's broken out, and now, sorry, that's not what I wanted. I knew it didn't look right. CompX here, here's NASDAQ, multi-year closing highs. This horizontal line is the close high level, so we've closed above it. So there's NASDAQ as a broad index, as opposed to what a lot of people look at as the Qs, which is the big cap. Completely different picture. Extended, yes. Up into resistance, yes, like the other ones. So keep an eye on it as well as the other ones. So hope that helps, and we'll see you next week. Hope you voted for your opinion on which way the market's going to go, and best wishes for your trading.